This lecture is on interest rate risk. Let me start by giving you an outline of today's lecture. There are different topics that I will discuss. We will start discussing sort of the context of where we should look at risk for, well, which is concerned with interest rate changes. As before, we look from the perspective of a financial institution, in this case a bank, and we need to understand how a bank makes money by borrowing money and lending money and receiving a spread for that. So that's the context where money is made and also where risk is carried by the bank. Then next topic on the list is interest rate dimensions. So if we think of interest rates as a driver for risk, then interest rates are far more difficult than other sources of risk, and that has to do with the fact that interest rates not only have an uncertainty over time, but there's also the case that interest rates, there's not just one interest rate, but there are many different interest rates, and in principle there is an interest rate with any different time to maturity, so we are looking to a broader perspective. Then the third topic on the agenda is the difference between yields and zero rates. Yields, as we will see later, is a variable which basically assumes that all the future cash flows can be discounted to today using the same interest rate, whereas zero rates have a more complete perspective on how to value future cash flows. And with zero rates, you impose that with a cash flow that occurs at a different time in the future, a different interest rate applies to discount. So in the case of yields, there is one source of uncertainty, there's one rate with which you discount, only one rate that could change over time. With zero rates, there are many points, many interest rates with different times to maturity that are applied to value, but then also are then all sources of risk. So that would give a more complete picture on how risk related to interest rate changes could occur for an interest rate sensitive portfolio. Then, very similar as with options, also for interest rate sensitive products, basically think of a bond, for example, or a loan. We will introduce risk measures, two of them, duration and convexity. And these risk measures in principle are related, go hand in hand with yields. So when we assume that there's only one discount rate available for all different times to maturities. And what they do is they are proper risk measures if we assume that the whole yield curve only could see parallel shifts and no other types of shifts in the yield curve. Then next we will move to the situation where we will use zero rates to discount or to represent interest rates uncertainty. So that means that there are many rates that could change on the yield curve, and then the risk measure needs to be slightly adapted. That new risk measure, we will call that partial duration. There will be a partial duration with each interest rate on the yield curve. And what this risk measure does, it allows not only for the risk of parallel shifts in the yield curve, but it also allows for taking into account other types of changes in the yield curve, so which I would call non-parallel. Think of rotations or say simply one segment where interest rates change and the other not. Then final point on the agenda for today is principal components method. So what that is that, well, first we have introduced risk measures, risk sensitivities. To what extent is a bond portfolio sensitive for changes in interest rates? So these measures, these sensitivity measures are called duration, convexity, and partial duration. Next of all, we also need to look to what extent could interest rates change over time. And since we are not looking to one interest rate that could change, but to a whole yield curve of interest rates that could change, we need to have a special model to represent these changes. And one of these models is a principal component model. So what it does, it says, well, given that you have the sensitivity for interest rate changes, now this model will also propose relevant interest rate changes, relevant changes in the whole yield curve to consider when you're going to assess interest rate risk. So first discussion is on, well, if you would look in a very stylized manner to one of the elements where a bank is involved in, the very traditional banking activity, how it all started, is that a bank is borrowing money, is receiving money from clients, and then seeks to lend this money again to other parties who are in need. And the idea really is that, of course, the bank tries to offer a low compensation to the parties that they are borrowing from, let's say the deposit holders, and they try to get a margin over that amount by lending the money to parties who are in need of receiving money. And this margin business is attractive as long as it's always the case that you could offer a low rate and receive a high rate. So then, if you would look to the balance sheet of a bank, then with regards to the borrowing and lending activity of a bank, then we see elements appearing on the left-hand side of the balance sheet, the assets, and on the right-hand side of the balance sheet. So on the left-hand side are the products that are offered by the bank and where they receive their money. So think of loans that they have offered to clients, mortgages, other type of interest rate sensitive products, leases, for example. And on the right-hand side of the balance sheet, the liability side, that's where we find the ways how banks finance these assets, so how they attract money. Think of savings deposits, but also they could issue bonds to receive funding from institutional investors, for example. So we see on the left-hand side and on the right-hand side of the balance sheet, we see interest rate sensitive products are building up. Well, what the bank really needs to do is they need to facilitate this banking book in such a way that there is a reasonably match between the assets and the liabilities. And what I mean by that is that the term of the products on the left-hand side, the asset, and the term of the products, the term of the ways of financing on the right-hand side, so the maturities, they need to reasonably matched. Because if there is a mismatch between these two terms, then it could be the case that there is still a long-term loan running, whereas the bank needs to attract new money to refinance that loan. And then if interest rates on funding money increase, then suddenly there is a risk that the margin that the bank tries to receive is going to shrink. So we call that roll risk. So roll risk, the risk that you need to refinance your assets with attracting new money, and that then the risks will be less favorable. So interest rate risk, and that's say what we are going to discuss today, really then stems from the mismatch between the assets and the liabilities. So if the characteristics of the products on the left-hand side in terms of cash flow moments and cash flow size are different from the right-hand side, then there is a mismatch, and as soon as there is a mismatch, it could mean that the interest rate changes in such a way that it's unattractive to a bank. So what we will do today, we will provide ways in measure those risks and also to see, well, how can you then manage those risks. Well, then these products on the left-hand side of the balance sheet and on the right-hand side of the balance sheet, they are interest rate sensitive. What I mean by that is that if you look to the product and you assign a single value to this product, then if interest rates in the market change, then the single value that you attach to a loan is changing as well. So what is the typical format of many of these interest rate sensitive products? Well, usually, at least very often, these are products which have a longer term. So that means, say, that there is a term of, for example, 5 years or 10 years, and that there is periodical cash flows associated with these products. So think, for example, of a loan or a bond, where, so well, initially there is money provided to the counterparty, to a customer, and then the customer has to repay coupons or interest rate on the principal, and in the end also has to pay, and say they have to do that on a regular basis, and also has to repay the principal in the end. So there are multiple cash flows associated with these interest rate sensitive products. So I've put here 5-year loan, 10-year mortgage, 30-year bond, all products which have in common that there is a longer term and that there is periodical cash flows that occur. This may be monthly, half-yearly, yearly. This may include interest rate payments, coupons, and also the principal repayment, of course. So these cash flows, most of the time, they are well known. We could say that these are, apart from a little credit risk that we will ignore for the moment, we could say that these cash flows are fixed. So we know that whenever there is a bond or a loan or a mortgage, for example, we know exactly what the future cash flows would be. But we are not so much interested only in these cash flows, but in particular, if we look to the balance sheet, we are interested in summarizing all these cash flows that belong to a mortgage or a bond or a loan, to summarize all these cash flows in a single number that represent the market value of that product. So how do we do that? Well, given that we know the cash flows, we simply need to discount all these cash flows back to today and add them up. And that number that then arises is the market value of that product. So what are we concerned with? If we look to a balance sheet, we are concerned with changes in these market values that are on the balance sheet. And because the cash flows are fixed, so we know what the future cash flows are that go with these products, the only source that could make the market values change is changes in the interest rates. Because if interest rates change, then that means that I'm going to use other interest rates to discount the fixed cash flows to today. Using other interest rates to discount the cash flows to today would then result in a different market value. That could be favorable or that could be unfavorable, but at least there is uncertainty in the market value. The market value of a product could change because interest rates change. And that's the important element of what we will be looking at today. So we have products that are longer terms, which have multiple cash flows. We are going to represent that in the balance sheet, both on the left-hand side and the right-hand side, with single values, the market values of those products. And these market values of the products are due to change because of changes in the interest rates, because then you use different discount rates. I mentioned it already while I was discussing the outline of today's talk. Interest rates have many different dimensions, and also there are many different interest rates. That's also the reason why interest rate risk is far more difficult to handle than, as we looked earlier, the risk of, for example, associated with options. So I mentioned a couple of interest rates which are very much alike and which are very much changing using common trends, but which are not exactly the same. So there are small differences there. So think of treasury rates, interbank rates, mortgage rates, deposit rates, and so on. So that's the first thing. So there may be many different interest rate products on your balance sheet. And then if you look to the valuation of those products, every time you have to use a slightly different interest rate, which makes it slightly complicated to have the relevant sources of uncertainty. So very often you need to make small adjustments to have common risk factors in that case to select the right interest rate. And the second thing is that interest rates, it's also something that I mentioned in the outline already, there is not such a thing as a single interest rate, but there is a different interest rate with a different term. So if I look to a loan which is due 1 year from now, and I would want to know the present value of that loan, I use a particular interest rate to discount that principal value. If that loan would have a different term, 2 years or 3 years or 4 years, I would use a different interest rate associated with a different term of the loan. So it matters at what moment the cash flow occurs, what interest rate would prevail to discount that cash flow. So we are not talking about a single interest rate, but we are talking about a whole yield curve of interest rates. And what the yield curve does, it has on the x-axis, it has the term of a loan, and on the y-axis, the interest rate that applies to discount cash flows with that particular term. So what is risk management then concerned with, given that we have this yield curve with all different interest rates that you could use for discounting future cash flows, giving you a market value. So risk management is concerned with changes in that yield curve. That could be parallel shifts in the yield curve, where the whole yield curve shifts up or down, or that could be non-parallel shifts, which, for example, could be a rotation of the yield curve. And because then this shift occurs in the yield curve, the market value of your products change. And risk management is concerned with measuring that effect, but also considering, well, what are the right types of changes to consider, and also how to manage then these risks. So here you see an example of a term structure of interest rate. So there are many different terms that we will use interchangeably. So here I call it term structure of interest rate. You also is refer that as a yield curve. On the x-axis is the time to maturity. So it starts at 1 year, 2 year, then you see 4 years, 6 years, 8 years, 10 years. And on the y-axis, there is the appropriate zero rate that applies. So the blue line in this case is our starting point, is the base case. So we see that the 1 year rate is 4%, and then the 10-year rate is, say, like 5.4%, and the yield curve is slightly moving up. So in principle, if today I want to know the market value of my bond portfolio, for example, I use the blue line to discount the cash flows that come with that bond portfolio. And then, if I would like to consider risks, I could say, well, let's assume that the interest rate yield curve, so the blue line, that it's going to shift. And there could be a parallel shift, so that's the red line. So what you see is that the blue line, then say there is every point on the blue line is moving up in the same manner to arrive at the red line. So the interest rates go up, then you use a new yield curve to discount all the future cash flows of your bond portfolio, which gives you a different market value. Then the green line is an alternative change of the yield curve. So we start again from the blue line and we move from the blue line to the green line. So in this case, the short-term maturity interest rates, they decrease, and the long-term maturity interest rates, they increase. So that's a different type of shift. You could call that a rotation. And then obviously it matters whether you have a parallel shift or a rotation, so to consider what the impact in the end is on the market value of your bond portfolio. And this is, in a nutshell, what we will be looking at. So we need to understand how to measure the sensitivity for these changes of a parallel shift and a non-parallel shift. That's where we will adopt the risk measures. And we need to propose a way to come up with viable type of interest rate changes. So what type of parallel shifts, what type of rotations, what type of non-parallel shifts should you consider if you look to interest rate risk. Then, an important element in the remainder of the models that we will use is that in this particular case, in all the formulas that follow, we assume that the interest rates that apply, and in these formulas here, the interest rate is denoted with the small r. These interest rates are continuously compounded interest rates. And what that means, it's different from discrete interest rate, is that to get from the value at time 0 to the value at time t, that means compounding. So I have an original value of P0 in this case, and I want to know what the value would be of this security if I wait until I am at time t. So suppose that this is a product that accumulates against a rate of r. Then what you need to do to know the value at time capital T, you take the value at time 0, the P0, and you need to compound, you need to use continuously compounding, and you do that by using the exponent function, so the e. And you do that then to the power plus r times t. Capital T is the term that is associated with the compounding, so you go from time 0 to time t. The r is the rate that applies, the interest rate that applies, and the plus means that I move in the future, so I accumulate. So then, second way to use interest rate with continuously compounding is when we look to discounting. So I have a cash flow in the future at time capital T. I denote that with PT. And I want to know what its value is today at time 0, P0. And what I need to do to discount this value at time t, the PT, to time 0, I need to use again the exponent, so the e power. And then there is a minus sign. The minus sign means that I'm going to discount. The r is the interest rate that applies for this time period. And the time period, the length is time capital T. So this is how we do discounting. And that will be in all the formulas that follow now. There is a reason why interest rates are compounded and discounted with continuously compounding with the exponent. And that has to do, there's basically two reasons for that. The first reason is that it makes it very easy and attractive to take derivatives of the exponent value, because the derivative of the exponent is the exponent itself times the derivative of what is within the functional form, within the parentheses. So that gives you very nice formulas. The second reason to use compounding is that if I do exponents times exponents, I again get exponents. And a third reason, which we will look at later, is that if we look to continuously compounded returns, so the R, then I can make assumptions which reasonably hold for the R in terms of their stochastic nature. And the important assumption that I can make is that these interest rates or these returns are approximately normally distributed. And that's a very nice property if later on I need to deal with future uncertainty. So let's look to zero rate curves. A zero rate curve means that there is a relationship between the maturity at which a cash flow occurs and the rate that you apply to discount that cash flow to today. So the reason why we call it zero rate curves is because we assume these are rates that apply to bonds that do not pay coupons. So there's only a single cash flow occurring, and that's at maturity of the bond. And then, so I want to know, say, this single cash flow that occurs at the maturity of the bond, what is its present value? So what's the value today? And that's, to do that, I need to use an interest rate to discount it, and I call that a zero rate, because it's a rate that is associated with a zero coupon bond, a bond that only has one cash flow at the end. So what the yield curve, the term structure of interest rate says is that, well, if there is a different term, then there should also be a different rate to use to discount. And in the particular example, which you see in the box on the right, there are the terms in the first column. So there is a 1-year bond, a 2-year bond, and a 3-year bond. These are all zero coupon bonds, so that means that they only pay the principal of 1 at maturity. And then there is a different rate to compound or discount with this term. So if I look to cash flows that occur in 1 year from now, if I want to know the present value of such a cash flow, this table says you need to use a zero rate of 3%. The table also says, well, if there would be a cash flow that occurs in 2 years from now, so a single cash flow in 2 years from now, and I want to know its present value, so the value at time 0, the rate that I need to use to discount is 4%. And then finally, if there is a cash flow that occurs in 3 years from now, so a single cash flow, and I want to know its present value, then the rate that I need to use to discount that cash flow to today is 5%. So you see there's a relationship. There are different terms, 1, 2, 3, and then with each term there is a different zero rate, 3, 4, and 5%. So let's then look to the left and let's look, say, how you should apply these formulas. So there is B03, B02, and B01. The B reflects the price of the bond. The 0 refers to the time where we determine the value. So time 0 is today. And then between parentheses, the 3, the 2, and the 1 refer to the term of the discount bond. So if I want to know the present value of a discount bond which has, say, a single payment at time 3, and this single payment is equal to 1, so then B03 says, well, what is the present value of such a discount bond? I take the principal value, so I take the cash flow that occurs at time 3, which is equal to 1, and then I need to discount, and to discount I use the exponent. There's the minus sign because I discount. There is the R3 because with a term 3 I need to use the spot rate or the zero rate that is associated with a 3-year term, and I need to multiply it with the term of the loan, so with the 3. So if you do that, and that's what you see in the table on the right, you arrive at a present value of a bond which gives a principal payment of 1 at time 3. The present value is 0.97. Sorry, is 0.86, because I do 3 times 5% with a minus sign, exponent times 1, that gives you 0.86. Similar things apply for the 2-year bond, where again, B02 means I look to the present value, the value at time 0 of a bond which in 2 years from now pays a principal value of 1, no other payments. So I take that principal value of 1, I multiply it with the exponent, there's the minus sign because I'm discounting, and I multiply it with the term of the loan. And then, so if you look to the table on the right, so there's the 1 times the exponent minus 4% times 2, gives a value of 0.92. And then for the 1-year bond, very similar. So the 3% for the interest rate, so the different interest rate times the term of 1 year with the minus sign because I discount, gives a value of 0.97. So this is maybe a simple example, but at least what it demonstrates is how you discount. So what the role is of the term, as you always need to include the term in the discounting. And also there is different interest rates for cash flows that occur at a different moment in time. So what the zero curve does, it allows you to price future bonds, or to price bonds in general, any type of bond, because if there are bonds that have coupons, then it means that there is not a single cash flow that is occurring, but there are multiple cash flows that are occurring. And then, given that you know the zero rates associated with all different terms, then a cash flow that occurs in 1 year from now, which could be a coupon payment, is then discounted with the 1 year zero rate. A cash flow that occurs in 2 years from now, which could be a coupon again, is discounted with the 2 year zero rate, and so on. So the zero curve, which in principle applies to single cash flows, could be used repeatedly to price bonds which do have multiple cash flows, because you simply then assume that the bond with multiple cash flows is like a basket of bonds which all have one cash flow. So let's see how that works. So I have a 3-year bond which pays annual coupons of 5%, and there's a principal repayment after 3 years. So I'm going to say, well, this single coupon bond is the same as 3 separate bonds, each with, say, a different term. So the first separate bond is then a bond which has a single payment of 5 in 1 year from now. That's the first coupon payment. So I do then 5 coupon payment. I need to discount it to today. So I use the exponent and then the -1 for discounting over a period of 1 year, times 3%, because 3% is the rate that applies to discounting a bond which has a cash flow 1 year from now. So then the second separate bond that I could consider is a bond which has a payment of 5, which is another coupon payment, in 2 years from now. So if I want to price that, then it's a single cash flow that occurs in 2 years from now. So then I need to discount it with the 2-year zero rate, which is 4%, times 2, because that's the term, with a minus sign because I'm discounting. So then it gives you 5 times the exponent of -2 times 4%. And then the third separate bond is the bond which has only a cash flow of 105 in 3 years from now. So I need to take that cash flow of 105 and I need to multiply that with the exponent of -3 times 5%. The 3 for the term, 3 years, the 5% because that's the rate that is applied to discounting cash flows that occur in 3 years from now. So I cut this coupon-bearing bond into 3 different pieces, which all could be considered discount bonds. So that gives me 3 separate values, which in the end I add up again to get to the value of the bond. So if I do that, then this coupon bond has a value of 99.84. So that's a nice way to say, well, hey, basically these zero rates are my building blocks to price any type of interest rate sensitive products. So any type of cash flow scheme that would occur. So for example, if I would look to a whole bond portfolio, then all these bonds have many different types of cash flows, and if I would add up all the cash flows at different maturities, I get maybe a very specific pattern. But still, if I want to do the valuation, I could assume that the cash flows that occur at any future time, I could treat them all as separate discount bonds and then also use the appropriate zero rate to discount that sum of cash flows back to time zero. So as an alternative for the zero rates, there is a yield. And when we introduce a yield, then there is the assumption that even though we think, or even though theory says that with a different term, there should be a different interest rate to discount that cash flow back to today. So if you introduce the yield, you say, well, it doesn't matter when a cash flow occurs with a bond, but all the future cash flows of a bond are discounted using the same interest rate. And that interest rate we refer to then as a yield. So there is an advantage of doing that, because instead of having a whole yield curve with different zero rates which could all change, so then you have many sources of uncertainty, so many sources of risk, then you simplify your life by saying, well, really there's only one source of uncertainty, that's the yield, and so that's much easier to handle with. So, well, this comes at a price, of course, because so it makes your life easier. There's only one source of uncertainty, but at the same time, if you say that it doesn't matter what the term is of the cash flow, you always will use the same yield to discount, then it also means that you assume that the term structure of interest rate is flat. And we know from practice that interest rates curves are not always flat. They can even be very steep. So it's an assumption, it's a simplification. And then on top of that, if you're going to look to interest rate risk, then the second thing that matters is that, well, if there's only one interest rate and you're going to change that interest rate, and this interest rate applies to cash flows with all different terms, then the only source of uncertainty that you consider is parallel shifts in the yield curves. So you are not considering the effect of non-parallel shifts. So again, you are less precise there. So is that a big problem? The answer is yes and no. So usually what we see is that 90% of the effect of changes is carried by parallel shifts in the yield curve. So there's only a small amount where the non-parallel elements play a role. But there could be specific situations where they are very dominant. So it's a simplification, it's less precise, but it's pretty well in many cases. So let's see what it means if I have a yield which I denote with a small y. So this yield then applies to all cash flows of a bond, no matter what the term. And so let's look again to the 3-year 5% coupon bond. So if I want to know the price of this coupon bond, then there is the coupon payment of 5 at time 1. So if I want to have the present value, I take the price of the cash flow, 5, I use the exponent, the minus sign to discount, the 1 because it's a term of 1, times the y. So the y is the relevant rate for the 1-year cash flow. So then there's also cash flow of 5 at time 2. To know its present value, I do again the cash flow value, 5, times the exponent, the minus sign because I discount, the 2 because the term is 2, times the same y, the same interest rate that I used to discount the 1-year cash flow. And then there is a cash flow at time 3, the principal repayment and the third coupon payment, so 105 in total. To have its present value, to determine its present value, I use again the exponent, minus sign because I discount the 3 because the term is 3 for this cash flow, times y again. So I use again the same discount rate as I did for the 2-year cash flow and the 1-year cash flow. I know from the earlier exercise that the value of this bond was 99.84. So then you can use a nonlinear search engine or a solver in Excel or whatever to see, well, what is then the yield that best applies to this bond. And if you do this search, you arrive at a yield of 5.43%. Then as a little step up to the risk measures, and here I really like to take a parallel discussion that we also had with options, a discussion which is very related to that. As well, with options, we said, well, an option is a derivative security because its value depends upon the underlying stock, for example. Well, with discount bonds, or with bonds in general, we say also that you could consider them to be derivative securities because their value depends upon the value of the interest rate or even of the whole yield curve or the whole zero curve. So the value, the market value of a bond, for example, is driven by changes in the yield curve. So given that the value of a bond is then derived from the value of the underlying yield curve, we say, well, it's a derivative security where the term structure of interest rates, or you also mention or you refer to that as the yield curve or the zero curve, are the driving factors. And what we will do is we will introduce sensitivities for small changes in the yield curve and for larger changes in the yield curve, which we will refer to as duration and convexity. And duration and convexity play a very similar role to what the delta and the gamma do for the price of an option. So where we had small changes in the underlying stock and larger changes in the underlying stock as risk measures for the price of an option, then the risk sensitivities with these small and larger changes in the underlying stocks, we refer to them as delta and gamma. With the price of a bond, we have sensitivities for small changes in the yield and larger changes in the yield, which we will then call respectively duration and convexity. So if we are going to do risk management with yields, then what matters is whether there is a small change in the yield or a larger change in the yield. If there's only a small change in the yield, then a single risk measure, the duration, is sufficient. If there is a larger change in the yield, then next to the duration, we also need to include convexity to cover the risk. And so really what we're going to do, we're going to say, well, the relationship between a bond and the interest rate is a nonlinear relationship. We do not very well know how to deal with nonlinear relationships, so we first are going to find a linear or linear quadratic approximation for that nonlinear relationship, and we do that again by determining a Taylor polynomial expansion, very similar to an option, only say with a bond it leads to far easier formulas, so it's far easier to determine these sensitivities. So let's look how this works. So we are now in the very simple case where we say, well, there's one source of uncertainty, and that's the yield of the bond, so that's the y. So in this case, we assume that all the future cash flows are discounted with the same interest rate, the yield. So we assume that the yield curve is flat because all the cash flows, all the interest rates to discount are the same. That means that there's a flat yield curve. And also, if we are going to look to risk management, The only thing that could happen is that we consider parallel shifts in the yield curve. Because if I change the y, it means that it changed for all terms because it's all the same. So the price of a coupon bond, denoted here with capital B, is the sum of all its future cash flows. And in this case, there are small n future cash flows. And these cash flows are denoted with CFI. And they are discounted to today to determine the market value using the exponent minus the yield, because the yield, the y, is always the discount rate no matter what the term of the cash flow is, times the moment that the cash flow occurs. So that in this case, that's denoted with TI. So please note that this is a nonlinear relationship between the price of the bond and the risk driver, the y, because there is an exponent in there. So that means that there's not a linear relationship that we are used to if we think of risk management. So what we would like to do is we would like to linearize this nonlinear relationship between the risk driver, the y, and the price of the bond, the B. So what does it look like if we do that? So I need to take partial derivatives and I need to evaluate them and so on. But then what happens is the next formula. So we arrive at a bond return formula, a bond return which is the change in the price of the bond because of a shock in the instantaneous shock in the yield. So that's the delta B divided by the original value of the bond B. So delta B over B is nothing else than a return on the bond. So what is the return that I made on the bond in a very small time interval? And what this formula says is, well, if you want to know what the effect is of a change in the yield, so that's the delta Y, on the bond return, which is on the left-hand side, then I need to know two things. I need to know a D and I need to know a C. The D is the duration, and there is so a minus sign, so it's minus the duration times the change in the yield determines what the return will be on the bond, so how the bond will change in price. And then if there are larger changes in the yield, so the yield is not so the change in the yield is not a small change, but say a larger yield, then you also include the convexity, denoted with the C. So you take half times the convexity times the change in the yield squared. So if the change in the yield is small, then you can ignore that second term on the right-hand side. If it's larger, you need to include it. And then the duration and the convexity can be determined very easily from the specifics of the bond, because the duration is the sum of all the times at which cash flows occur, and you multiply them with the discounted cash flow associated with that term divided by the price of the bond, the market value of the bond. For the for the convexity formula, you do something very similar. You take all the moments that the cash flows occur, but you square them, and also these you multiply with the discounted value of those cash flows divided by the B. So this is like mechanically determining the sensitivities, the duration and the convexity, the interest rate sensitivities that we are interested at. One other thing to mention, so the cash flow, the discounted cash flow divided by the price of the bond could be interpreted as a weight. So how important is this time? So to what extent do I weigh it, say, as a contribution to the duration? Because if you look to the numerator of everything that is in parentheses, so the discounted cash flow, if I would take all the discounted cash flows together, so I take all the numerators together, then that's exactly the sum of all the discounted cash flows is exactly the price of the bond. Given that I also divide by the price of the bond, then I exactly arrive at a value of 1. So that means that each term here individually is a weight. So that applies for the duration, and that also applies for the convexity. An example, so the 3-year 5% coupon bond. So I have 3 time moments where cash flows occur, time 1, time 2, time 3. There's 3 cash flows, 5, 5, and 105. And I'm going to look to the discounted cash flows associated with these 3 cash flows. So I am in the situation of a yield, so I apply always the same discount interest rate, so the Y. And if I do that, I arrive at values 4.74, 4.49, 89.22. So then next what I'm going to do is I'm going to determine the price of this bond, which is the sum of all the discounted cash flows. So I add up 4.74 plus 4.49 plus 89.22 gives me the price of 98.4. Then this price of 98.4 I'm going to use to determine the weights associated with each cash flow. So I take the 4.74, which is the discounted cash flow associated with time 1, and I divide it by the price of 98.4, which gives me a weight of approximately 5%. I do the same thing with the second discounted cash flow at time 2, which is 4.49, and I divide it again by the price of this coupon bond of 98.4, which also gives me a rate of approximately 5%. And then third case at time 3, so there is the discounted cash flow, which is equal to 89.22. I also divide that by the price of the bond of 98.4, which gives me a rate of approximately 91%. So what this also shows is that in this case, the most important contribution to the duration and then also to the sensitivity for interest rate risk is the third term. So is the principal repayment at time 3, because there's 91% that I attach to this value. So this gives me weights. Then these weights I'm going to use to multiply them with the moments in time. So I take the weight of 5% times time 1, gives me 0.05. The weight of 5% times time 2 gives me approximately 0.09. And there is the weight of 91% times the time 3, that gives me 2.72. So if I add these 3 numbers up, so the 0.05, 0.09, and 2.72, that gives me the duration, denoted with the D, of 2.86. Then, last thing to do, in order to arrive at the convexity, I need to take the weighted value of all the times squared. So I take 1 squared times the weight is 0.05. I take 2 squared, which is 4, times 5% is 0.18. And I take 3 squared, which is 9, times 91% is 8.16. So in total, if I add these numbers up, 0.05 plus 0.18 plus 8.16, gives me a convexity of 8.39. So then I've repeated the formulas that I just applied at the bottom. So you see that the weight is the discounted cash flow divided by the price of the bond. The duration is the weighted time, and the convexity is the weights of the squared times. So reasonably easy to determine them to get to your risk measures. And of course, you could do this exercise for each bond in your portfolio. So the question is, once you have done that, so you first look to the price that you observe for each bond, then you determine the yield that goes with that, and then you're going to do the determination of your durations and convexities for each bonds. And then the question is, well, of course, I'm not only concerned with each bond individually, but in fact, I would like to treat interest rate risk on a portfolio level. So how do I do that? Well, let's assume that there are many bonds in your portfolio. Let's say there's small n number of bonds in your portfolio, and that with xi we denote the value, the market value of bond I. And then the di is the duration that we just calculated on the previous slide. So if then I would look to the total value of my portfolio, which I denote with capital P, then that's simply the sum of all the market values of the individual bonds. So that's the formula on the right-hand side. The P is equal to the sum of all the values of the individual bonds. Then once you know that, then it's very easy to determine the duration and the convexity of your portfolio of bonds, because really what you do is that you take a weighted average of the durations of all these individual bonds. So you say, well, I look to the value, the market value of the bond that I consider. I divide it by the market value of my entire bond portfolio, and I multiply it with the duration of that individual bond. I do that for all the cases, and I add them up. So that's what the sum does. For convexity, something very identical applies. So also there, I first have determined my convexities at the individual bond level. So that's the CI. The CI is the convexity that is associated with bond I. XI is the market value of that bond, and P is the total value of my bond portfolio. So I simply determine per bond what its value is as a percentage of the total values. That's XI over P. I multiply it with the convexity of the individual bond, and once I've done that, I sum them all up. So the schedule then to do risk management for a whole bond portfolio is to start with the assessment on the individual bond level. I determine market value yields, durations and convexities at the individual bond level, and then afterwards I take the weighted average of these durations and convexities to understand what the sensitivity is for yield changes for my entire bond portfolio. So quite easy. So next we move to the more general case. So now we have dealt with the situation where we said, well, we assume that no matter what the term is of a cash flow, we can always use the same interest rate to discount this cash flow. That was the yield, the Y. So now we go to the more general case where we say, well, if there is a different term of a cash flow, then also the discount rate needs to be different. And the zero yields, I denote them with a small r, and there's a subscript with the small r, the I, and the I reflects the term of the cash flow. So I have R1 as the zero rate that I use to discount cash flows that occur at time 1. I have the R2, which is the zero rate that I use to discount cash flows at time 2, and so on. So now I have many sources of uncertainty because each of these zero rates, R1, R2, R3, until Rn, could change in different ways, not necessarily parallel, could also be any type of other change. And then the question is, well, how do I do risk management in this more general case? Well, to begin with, we need to look to the price of a bond if we use zero yields. That price is denoted with the capital B. And then really what you do is you look to all the future cash flows, very often that are coupon payments, but then at the last moment it's a coupon payment and a principal repayment. So those are the cash flows I. And I discount them back to time 0. I use the exponent for that, the minus sign for discounting, and then the RI to appreciate that this is a cash flow at time I, and I need to use a different interest rate, which is RI, to do that, and I multiply that with the specific term of that discount, which is TI. So now there are n risk drivers. So the R1, R2, R3, R4, and so on. And then the question is, well, how do I now determine, say, the interest rate sensitivity of a bond? So what's now the bond return if these yields, these zero yields are going to change? These zero yields are going to change. So that's the next formula. On the left-hand side, it says bond return, because the numerator is a change in bond price and the denominator is the original bond price. So that's a return. So the return is a minus sign, same as with the original duration formula. But now I take the sum of many durations, partial durations, di part. So there is a different duration with a different term, and with a different interest rate as risk source. So there's the partial durations, di part, that I multiply with a change in a specific interest rate on the yield curve. So in this case, there's a change in the interest rate RI, which is a change in the interest rate that applies to discounting cash flows at time I. Given that I sum over 1 to n, I take account of all the changes which could be different for each interest rate over time, and I add them up. So I need to know now how to determine the interest rate sensitivity for a change in a particular interest rate at that yield curve, so for RI, and that's what we call a partial duration. So to determine the partial duration, you take minus 1 over the value of the bond price, and then you take the partial derivative of the value of the bond price with respect to only that point on the yield curve, only that zero rate RI. So if you do that, so in the formula above, so you take the derivative of the exponent, which is quite easy. Then you arrive at this formula. So the exponent of minus RI times TI divided by B times TI. And there is cash flow I is missing in this formula. So that should also be added to the numerator. So an example of how this works. So I look to a 5-year 5% coupon bond. The first column gives the times that the different cash flows occur, so time 1, 2, 3, 4, 5. The second column gives the different yields, or the different zero yields that apply. So if I want to discount a cash flow that occurs at time 1, I use 4% to discount that cash flow. At time 2, 4.5%, time 3, 4.8, then 5 and 5.1. So we see that there is a different zero yield with a different maturity. So that's the yield curve. Then the cash flows that come with a 5-year 5% coupon bond is the coupon payment of 5 in every year. And on top of that, in the last year at time 5, there's also the principal repayment of 100. So that gives you a coupon payment of, that gives you a total cash flow of 105. So then I'm going to use the zero yields to discount the cash flows. So that is then a specific discount rate with a specific time point. So that's the next column, 4.8, 4.57, 4.33, and so on. So once I have determined these value of the discounted cash flows, I can add them up, and that gives me a price of 99.16. And this price of 99.16, I use it in the next column to determine weights. And these weights, I've denoted them with a VI. And the reason why I did not put WI is because WI we used earlier already as a weight, but those were weights if I would discount using the yield. And here I'm not using the yield to discount, but here I use the specific zero rates to discount. So we will arrive at slightly different weights than if we would have used yields. So I wanted to make that the difference visible. So I get 4.8 divided by 99.16 is approximately 5%. 4.57 divided by 99.16 is approximately 5%, and so on. Gives me all the VIs. And then the partial durations are determined by multiplying those weights times the time at which the cash flow takes place. So in the first case, it's 5% times 1, so 0.05. In the second case, it's 2 times 5%, it's almost 0.09 approximately. Then third case, 3 times 4% is approximately 0.13, and so on. So that gives me the partial durations with, which apply to changes in the yield curves at moment 1, 2, 3, 4, 5, etc. Then in the next column, I have assumed specific changes in the zero yields. So the first zero yield, which term 1, will see an instantaneous decrease of 10 basis points, minus 0.1%. The second zero yield at time 2 will see a change of 5 basis points decrease, minus 0.05%. The third zero yield will not change, so DR for the third one is 0. Then the fourth zero yield will increase with 5 basis points, so plus 0.05%, and the fifth one will increase with 10 basis points, so plus 0.10%. So what you see here is that using the partial durations allows for non-parallel shifts in the yield curve. So some of them see a decrease, other ones do not change at all, and then the thirds, they increase. So if I want to then understand what the effect is on the return of the bond, overall bond, then I need to take the partial duration times the change in that particular yield curve. So in the first case, it's the partial duration of 0.05 times minus 0.1%. It's very small, so the contribution to a change in the return of the bond, it's 0 if I look to numbers accuracy. Same applies to the second one, the third one. Then the fourth one, I see a partial duration of 0.17 times 5 basis points change. So that's a 1 basis point effect on the return of the bond. And then for the fifth one, there is a partial duration of 4.1 multiplied with the 10 basis points increase, which says that the product of the two is 0.41. So that means an impact of 41 basis points on the return of the bond. So then at the bottom, I add up all these products of the partial durations times their associated change in the zero yield. That gives me approximately 0.41, 0.42%. So that's the return on the bond. But I need to add a minus sign there. So that's also so what you see in the formula below. It's minus the sum of all the products of the partial durations with the changes in the zero yields. So if this yield curve has this nonlinear change, as proposed in the, so it's a rotation of the zero curve, with the minus 10 basis points, minus 5 basis points, the 0, 5 basis points plus, 10 basis points plus, then the return on the bond portfolio is that it will decrease with 41, 42 basis points. So now, next, in the table at the bottom, what I did is that instead of using the approximation that was used in the upper table, I'm going to do the exact calculation of the new bond price. So I have exactly the same terms, I have exactly the same cash flows, but to discount the different So in the table at the bottom, I do the exact calculation of the bond when the yield changes have occurred. So I have exactly the same times that apply, I have exactly the same cash flows, but the zero yields are now altered to take account for the change in the yield curve. So instead of 4%, I have 4%. And then minus the 10 basis points, which is the change, which gives me 3.9%. Then the second is the 4.5% minus the 5 basis points is 4.45%, and so on. And now simply what I will do is I will look what the discounted cash flows are using these new rates, and then I will determine the new price. And then that's what happens in the fourth column. So I see a price of 98.76. So with this change, with this rotation in the zero curve, I get new zero yields, and if I apply these zero yields, I get a new price of the bond, which then means that there is a price decrease from 99.16 to 98.76. So I use here the exact calculation of the new price of the bond, which means that if I do the return of the bond, so I look to the new value of 98.76 minus the 99.16 divided by the 99.16 is also minus 41 basis points. So this is simply to demonstrate that what we do at the top with the partial durations and then with the rotation in the zero curve leads to a return, instantaneous effect on the bond portfolio of minus 41 basis points, which is the same as when we would do the exact calculation by simply looking to the new value of the bond. To also appreciate that the formulas actually work well. So another example of risk management with zero yields. So what I want to do here is I want to look to a situation where we have again the relationship between the return on the bond and the instantaneous change in the zero yields using the partial durations again, multiple points at the yield curve, in this case term 1, 2, 3, 4, 5, 7 and 10. That's where cash flows occur. And we have calculated their partial durations there already, 0.19, 0.34, and so on. So this is the situation of a particular bond portfolio that we arrive at. And what I want to do here is I want to first look to a rotation, and then I want to look to a parallel shift. Please recall that the rotation is possible when I use zero yields and partial durations, and the parallel shift is also possible in that case, but in the case where we were using yields, only parallel shifts are possible, so we cannot see the effect of rotations. And so what I do here is that I look to a particular shift in the yield curve, which is a rotation, so minus 3% on the first zero rate, minus 2% on the second, minus 1 on the third, no change in the 4-year rate, then the 1% increase in the 5, 3% in the 7, and 10, for the 10 it's 6%. These are enormous changes, but it's also chosen as an example to really see a big effect. So if the changes are small, the effect is small, but still it's there. So if I want to look to the effect, I need to multiply the partial duration with the change in the spot, so times the shift, and then if I add them all up and I put the minus sign, I get the total effect. So with this particular rotation, we see that that it leads to a decrease of almost 7% in the bond portfolio. And that has in particular to do with the big impact of interest rate increases at the long end of the yield curve, because there we see, for example, an effect of minus 5.48% for the 10-year. You need to put a minus sign in front of that, so that's almost taking care of 5.5% effect on the bond return change. Then in the second scenario, that's where we assume a parallel increase, so all the yields move up with 1%. You need to multiply these changes again with the partial durations, and then you need to add them all up with the minus sign, and then we arrive at a total effect of minus 3.95, which says that, well, if I would look to only a parallel shift, then in this case, we see that the bond return decreases with 4%. So here we see that if we do not allow for non-parallel shifts, it may be the case that we are understating the risk that applies to a particular bond portfolio. So sometimes rotations matter, and sometimes they don't. So sometimes it's important to use zero yields with partial durations to assess the risk, and sometimes it's sufficient simply to use yields and to only look for parallel shifts. Well, in the case of zero yields and using partial durations, you can do both, and then you could also see what the effect is. Well, do I think that there will be only a parallel shift, or do I think that it could also be non-parallel shifts in the yield curve? So then, the last part of this lecture, we are again looking to this most complete formula where we say, well, we look to the instantaneous effect on a bond portfolio. So what's the bond return if the zero curve is changing? So the risk drivers are the changes in the RIs in that case. We saw that the partial durations measure these sensitivities, and there's a minus sign in front. So there is two things to consider here. So there is an effect which relates to the partial durations, the DI part, and there is an effect coming from the DRI. So if I would want to answer the question, what is the sensitivity of my bond portfolio for changes in the zero curve, then my answer is, well, look to the partial durations. Well, how sensitive am I for changes? Well, that does not tell me yet, say, if I run a lot of risk, because I could be very sensitive for changes in the yield curve. But if the yield curve is not changing, then there is no risk. So I also need to answer a second question, and the second question is, well, how do yield curve changes occur? So what are the proper yield curve changes to consider? So is it simply that I state, well, look to one parallel shift or to a rotation? How important is a rotation? What are the sizes of these rotations? So I need to get an informed consideration on what type of yield curve changes to consider. And the way that we are going to do that, the way that we propose to do that, is to say, well, let's propose a model for yield curve changes that's based on historical data. So what I will do is I will look to a whole bunch of historical yield curves on a daily basis, and then determine a principal component model for these daily changes. And this model then afterwards I can apply to determine the DRIs in this case. So what does the principal component model give me? It gives me on the left-hand side the changes in the different zero yields, difference in the 1-year rate, difference in the 2-year rate, 3-year rate, 4, 5, 7, 10-year rate, and 30-year rate. And it gives me that as a relationship with 8 factors, F1, F2, F3, etc. So the table with all the numbers, we call that the vector loadings. So, and these numbers are really per column are standardized eigenvectors. What I need to do to determine these eigenvectors, I look to all the historical daily data that I have for all these points on the yield curves, and I determine the covariance matrix of all these changes. And then once I've done that, I get a covariance matrix for daily changes in the yield curve, and for this covariance matrix, I determine the eigenvalues and the eigenvectors. And these eigenvectors, I further standardize them so that, that they have a dimension of 1, so that if I take the square of all the elements in a column and I add it up, it's exactly equal to 1. So that's a technical detail, how to determine eigenvalues and eigenvectors. The important thing here is that now I very simply have a relationship between changes in zero yields, zero rates, and 8 factors. And these 8 factors, they are constructed in such a way that they are all independent of each other, and they all have as variance, they have the eigenvalue of this historical covariance matrix again that I just mentioned. So here you see this these 8 factors. So they have a mean 0, and then they only have a covariance matrix with on the diagonal the variances that apply to them. So the variances of the daily factors. These variances are expressed in basis points. So they apply to a 1-day period, and so I need to multiply them with 0.01% to get the exact number. A basis point is 0.01%. So what this representation tells me is that, well, I've ordered the factors in terms of importance, is that the first factor picks up most of the variance, explains most of the changes in the yield curve. So it's the most important factor. That's what the variance of 17.35 tells me. The second factor, 4.77 as variance, is then second most important to explain the variance in all the yield curve, and so on. What we know is that the first and the second factor, so the first factor explains already more than 90%, the first and the second factor already more than 98% or something like that of the total variance. So very often we say, well, if you simply would include 2 to 3 factors, then you can simply ignore the other factors, and then you have a proper representation of how factors could move and what the impact is on changes in the yield curve. So if now I want to understand what the effect is on my bond portfolio based on this principal component model, then given that I know that the factors are normally distributed and I know what their variances are, I could simply do random drawings of each of these factors. And then with each random drawing, there is using the factor loadings, there is changes in the zero yields that can be calculated, and these can be multiplied with the partial durations, and that gives me then an effect on the return of the bond. So if I do many drawings from this normally distributed factors, then I get many different realizations for the factors. I get many different possible changes in the zero curves. I get many different effects on the bond return because of changes. So that gives me then almost like a histogram or a distribution of possible changes in the bond return, which then of course helps me to say, well, what are the most likely changes, what are the most severe changes that could occur, and so on. So the principal component model gives me a way to look to possible changes in the zero curves based on how these changes occurred historically. So if you look to the factor loadings one more time, then you see that in the first column, which is then the most important factor, we see that the values are almost all the same. You see that here you see 0.216, 0.331, 0.372, 0.392, and so on. These are very similar values. So that's what we call, that factor has the interpretation of a change in the level of the yield curve, so a parallel shift. The second factor, we call it a change in the slope. So if you would look to the second factor, you see minus 0.5, minus 0.42, minus 0.26, minus 0.11, and then it goes up, positive, and then more positive, so that's a slope change. So that second factor, we call that the slope factor, and the third factor is a curvature factor. What we also know if we look to the variances of the first, second, and third factor is that the first factor already explains 91%, the second factor 6.8%, and the third factor 1.3% of interest rate changes. That means that the most important change that occurs usually to yield curves is parallel shifts. 91% almost of changes could be attributed to that. So if that's the most important shift, that also explains why, even though we have the more complete way of looking to interest rate sensitivity by using partial durations, the model where we simply assume yields and parallel shifts is not so bad in many cases. Almost 91% is explained by that model, so that works pretty well. Then the change in slope, it contributes 6.8%, and the curvature 1.3%. So still almost 7% of the possible changes come from the fact that, that there is a rotation in the yield curve. So if we look to the first three factors, then we are already say at more than 99%. So that means that even though I also have the sensitivity to 5 remaining factors, that effect is that small that we also could simply ignore these factors. So we could simply say, well, let's draw from the first 3 factors. Let's look what the factor loadings are, then let's look what then the effect is on the possible changes in the spot, in the zero curve, and then say using the partial durations what the effect is on the bond return. So once more, what interest rate curves should you, changes should you consider? Primarily parallel shifts and slope changes. Because the factor variance gives you an idea, say, how important they are. 91% importance for the parallel shifts, almost 7% for the slope changes. So this is where your focus should be if you do risk management. And that concludes today's session. Thank you.